I just recorded one of my favorite episodes of Housing News of all time. Today's guest was actually referred to me by two of my team members at HW Media, Jennifer Laws, who leads our sales organization, and Mike Simonson, the president and founder of Altos Research. They both suggested that I have to have Alex Villacorta on the Housing News podcast to learn more about his expertise in housing data and how he, as a co-founder and chief data officer at ResiShares, is applying housing data to make smarter investment decisions. ResiShares is specifically focused on the single-family rental asset class, and we go deep into his understanding and investment strategy of acquiring and operating and raising capital to own single-family rental assets and how they're applying data to educate a really smart and differentiated strategy. Alex has an incredibly impressive background in the housing industry with experience at some of the most innovative valuation and appraisal companies in the ecosystem. In his background with a PhD as a statistician, Alex approaches the housing ecosystem with a very different lens than many other guests that we have had on this show. In the second half of the episode, Alex goes out on a limb and makes some predictions for 2023 based off the data that he and his colleagues at ResiShares are analyzing and making bets on. I hope you enjoy this episode with Alex Villacorta, co-founder and chief data officer at ResiShares.
Hi, this is Sarah Wheeler, editor-in-chief of HW Media, and I'm talking to Ed Messman, CEO at Rook Capital, about their shared value investment program. Ed, what sort of investors are most interested and supportive?
Yeah, we're finding that there's three types of investors that are most interested. Those that care about housing affordability for this generation. Foundations, family offices are in that category. Secondly, those that care about their local communities, and those would be individuals, employers, that really are concerned about their local communities. And then lastly, just overall investors that are interested in the asset class of single-family, owner-occupied residential.
Thanks, Ed. And listeners, you can find out more at rook.capital.
All right, really interesting, Alex. All right, so you guys have done a lot of work and analysis and content, and I was jumping through some of your blog posts from you and your CEO and team and co-founders, and one post really caught my attention. That was your predictions post, which seems like it's something that ResiShares has done a couple of times. There's a 2022 predictions, and y'all were kind enough to fact check yourself and give yourself a 5 out of 10 on 2022 predictions, which isn't that bad in a year where like the world kind of got turned upside down, and we saw the fastest rate increase of my recent memory. And you went ahead and did 2023 predictions. And I want to go macro and talk about a couple of these 10 predictions. I pulled out 5 that I think are relevant to the conversation here. One we're writing about quite frequently. Logan Motoshami, our lead analyst, is talking about the economic data daily. The first prediction is the Fed will engineer a soft landing and we'll hate it. How are you thinking about Fed impact and the potential for a soft landing where we are today in May of 2023?
Yeah. That's a great question. It's funny. I know Mike, our CEO, will hear this later, and I'm sure he's smiling to himself. But, at least for the way I see it, is it's not so much of, I wouldn't give so much credit to the Fed as truly engineering something. Like, there are so many different forces at play. It seems a little, unfair to either credit or blame the Fed for everything. It's obviously a very complex, economy. But that being said, what we're seeing in the housing market with the backdrop of as you just noted, the largest rate increase of all of our recent memory, and prices are going up. There is, going back to our earlier conversation about why we even got into the rental, why we're still bullish. Those reasons are still at play today, and we see this again with the kind of the bounce back on home prices this last spring and currently in progress. Again, Mike at Altos talking about the inventory. That's the big issue. I was talking about that back a few years ago. It's still
absorption. It's nuts.
Yeah, exactly. All of these issues are still very, very prevalent. So with the Fed and their decisioning to raise rates, the big recession that I think we all thought was going to happen by now obviously hasn't. It's still May, of course. We're not completely out of the woods yet, but the job growth, the wage growth, employment picture, the housing inventory, there's a lot of these things that are lending themselves to that prediction of a soft landing. And then to the other point of why we're going to hate it is because it just puts us in the mud still. We're just like, well, it's not totally bad, but it's not totally great either. And we're just kind of in the middle. And so from an investment point of view, from a home buying point of view, from the mortgage servicing point of view, when there's that much uncertainty of like, well, this can go either way, goes back to what I was mentioning earlier. A lot of us entrench ourselves in just sitting on the sidelines to just, let's see which way this actually ends up turning. And that's the part that I think we're not going to like. And the way here we are in May, it looks like this is going to be the way forward. Although personally, I'm more bullish on where the economy is going to go. I think it certainly will be a soft landing, but who knows? We still got time to see.
Okay, leads us into the second prediction, which you hit on a little bit there. But rents will be higher on average nationwide by the end of the year. On average might be a key word in that in this prediction. And housing prices will be up in certain markets. Let's give us your glimpse and evaluation. This prediction is about 3.5, 4 months old at this point, so you get the advantage of time and data. So how are you feeling about this prediction?
Feeling good on I'll start with the rents. The rents, I think this one will check the box. There obviously was some price softening, some rental price softening over the winter. That's largely, I believe, attributed to seasonality. I think we're already starting to see that come back. Again, last I checked, there aren't hundreds of thousands or even millions of new homes that were built over the last month. So, there's always going to be this shortage of demand, which again will take decades for us to dig our way out of. So given that, I think rents will maybe not bring back all the gains that were lost over the last 6 months, but I think we will be on average higher than we were to close the year. As far as home prices in general, I think we're already seeing, I think the box is already checked unless there's an issue to unfold in the second half of the year. We've already seen prices, again, on an average scale, largely come back to or knocking on the doorstep of their highs of the last year, which is quite remarkable. That if you're looking, that's the V, the V-shaped recovery, if you will. So I think that one will get a point for both the rental and the home price.
Hey, so if you're like a buyer of rental performing real estate assets, do you hate a market where rents are flat to down, or does that present a buying opportunity for like future scale? Like, how do you think about like the attractiveness of a strong market versus a soft market as you're building a scaled portfolio?
Yeah, great question. Ultimately, the answer to that always depends on where it's going next.
Yeah.
So the fact that if we're in a softening market like we were in the winter with rental prices, that is either the worst time to be going into the market or the best time to go into the market, depending on what you think is going to happen in the next 6 months.
It's the beauty of a marketplace. They never suck for everybody at once. Like
exactly. So that's I don't know how satisfactory your answer is, but that's how we look at it. That whether the market's up, down, or sideways, it ultimately depends on what you think is going to happen next. And I argue sideways goes back to the opening question. That's the part we all hate because it isn't clear. It could go either way. But when prices are going down, whether it's in the rental or the asset values, in general, we like that. If this isn't the start of this prolonged decline, if we feel like the inflection point is right around the corner, we love it. Conversely, on when everything's kind of ripping and going high, generally we like it, but we also don't want to be flying off that cliff when there's the next inflection point. So again, that's where our data analytics come in. That's where our modeling comes in, our forecasting, all those things. And in fact, that brings me back to T-Rex. That's a lot of what's on there as well. If you notice, we have the 3-year forecasted projection on where we think this market is going to land. And that's, again, largely informs, our investment decision when we're building out portfolios.
Okay, I'm going to run through 3 more predictions. And this next one is extremely timely, and we might actually have some answers or resolution to it by the time this episode publishes. But number 7, which is the third one we're going to review, but number 7 on your list, the Republican-controlled Congress will block an increase to the debt ceiling later this year, forcing the Treasury to mint high-denomination coins to prevent a U.S. sovereign debt default.
I'm going to have to punt on that one. I know Mike has strong views on that one. I'll say this. I sure hope not. I think with all this uncertainty that we were just talking about, this is really the last thing I think this economy needs. But whether it happens or not, and kind of what the fallout or what the response would be if that did happen, I mean, your guess is as good as mine. But I guess, like I said, I'll just leave it as I sure hope not.
Yeah, I'll second that. Okay. Next prediction, OpenAI will emerge as the single most disruptive business in history. By late 2023, new businesses will raise billions in seed capital to compete with it, build on top of it, exploit it, and educate people using it. And you did flirt with some AI topics earlier in the conversation. So give us your views.
Yeah, I think that one's pretty much in the bag. I mean, from what we've seen so far this year. And I love it. I mean, again, I'm a statistician. I've been in this game long enough. I joke with a lot of my colleagues and people I've worked with in the past that before data science, there was statistics. And that's what we called ourselves, statistician. It wasn't about data science. And so, AI, this intelligence has always been at the root of statistics. So if you go back to, Mendel and Ronald Fisher and some of these seminal statisticians, they were always trying to find the intelligence through data. If you're measuring your yield on your corn crop, you're trying to take measurements of the soil and the temperature and the humidity and all these things so that you can predict yield. So now that the world has datafied everything, it's natural. It's a natural evolution that we would apply these tools that have been around for hundreds of years to data sets that are now just emerging. And when that happens, you discover new things, you have new applications, you have new tools. It's going to shift how we use, it shifted how farming was done hundreds of years ago. It's going to shift how we live today. So I think that one's in the bag for us. It'll be interesting to see what happens in the subsequent years, but certainly we've already seen plenty of investment and excitement about the AI field.
Can you spotlight a couple of use cases in the real estate and housing ecosystem that you're particularly excited about? And we've seen some of the low-hanging fruit stuff get a lot of attention, like real estate agents using OpenAI or ChatGPT to write social posts or emails, or I think we've seen some creative use cases on drafting, at least drafts of legal docs and offer letters. Yeah. But what else what are you keeping your eye on? As a statistician who, is a little more, technical than our average industry participant?
Well, I'll speak what I know. As I mentioned earlier in our talk here, valuation is so critical to everything in real estate. I mentioned how it's made up of three different components. I mentioned how one's in the bag already done. The other one is being innovated today. It's that third one. The third one where I feel like AI and a lot of these language models will have a pretty significant role to play. I think that there's opportunity for big disruption there. And again, it's because a lot of these language models and these AIs are synthesizing disparate data from all over and bringing it into something that's human readable, and not just human readable, but is comprehensible, that it quote unquote makes sense. You have, Bard or ChatGPT, whoever your favorite AI is, go out, you ask it a question, and it gives you an intelligent answer based upon the data that is trained on. If you look to valuation, you could ask, I could argue that we ask this question of valuation every single day. What is the value of this house? And how does it compare to the local market? That is a fundamental question. Pretty much every real estate participant, from your agents to your home buyer, to your servicer, to your mortgager, to investor, etc., we all are asking this very fundamental question. So enter AI, enter this tech. Now, if you could say, well, great, I have photos for you to look at, I have data for you to analyze, and now I need a comprehensive human readable summary to tell me what's the big picture here. That, I don't know how near or far we are from that happening, but I think that the methodologies, the algorithms, and the data certainly exist for that to happen.
Is the application there yet to go back and back check those views? And Resi Shares is kind enough to go back and back check your own 2022 predictions. If AI becomes a dominant source of knowledge in the valuation space. What do you think, like, how do we take like future sale data and go back and like back check the triangulation to make sure that we're training the models to get better over time?
Yeah, that's it. I mean, that's the key. That has to be done.
Yep.
If that is not done, then I think a lot of the warnings and the risks that you've read about in other industries, other applications, that just is kind of breeds the environment for that, kind of, I'm hesitating to use the word misinformation, but kind of misinterpretation to be propagated. If there isn't that feedback loop and that reinforcement. Yeah. So as it pertains to housing, absolutely. You need some sort of responsible model development to make sure that feedback loop is happening. And again, I'm encouraged because that exists today. And even the very simple AI of AVMs, just coming up with that one number for all the entities that I've worked with and for, the amount of rigor that is required from the GSEs and lenders in particular to ensure that the models that lending decisions are potentially based upon are significant. And so, that type of rigor and oversight for model development, I think if that can be maintained and if that can be audited in a way where you can go back and say, okay, well, great, you have a new version 2.0 of your chat valuation model. Great. Let's see how it worked in 2004. Let's see how it worked in 2006, how it worked in 2009, and so on and so on. So without that, then it's quite irresponsible.
I mean, as a statistician by background, I mean, all calculations like come with a margin of error, knowing like how like many standard deviations you're off from perfection and accuracy. And like that seems to be something that the GSEs are getting like increasingly comfortable with, is like, what does accuracy look like? To what percent is the confidence interval? And like, and that's like, we don't need perfection for lending valuation. We need a range that we know where we sit in the range, and which can inform underwriting decisions.
Exactly. 100%. Yeah. And in fact, I think that's a great way to say that, because any model whatsoever always has a degree of accuracy or a degree of uncertainty, going back to the science of uncertainty. And without that, it doesn't provide the right context. So for example, if, I was to guess, the value of your house and say, oh, I think Clayton's house is $500,000. And I'm saying that to a lender. That's one thing. But if I would say, I think it's $500,000, but it could either be 400 or it could be 700. That's a completely different message to the person receiving that information. So without that context, which is again, that third component that brings it all together, without that context, I feel whatever the model is and whatever the application, it just lends people to this unwarranted level of trust that, well, that's what the computer screen said to me, so it must be right.
But if the computer screen can say, hey, we're confident it's 500 or within a degree of confidence, but in this one scenario, it might be between 400 and 700, that should be like the AI trigger to initiate a traditional appraisal and hey, if we can't get confident with the data and the triangulation of information, then we go to plan B, which is maybe higher cost or takes more time, but like a limit comes down to a tighter margin of error.
Exactly. And that's what's being done today. These appraisal waiver programs by the GSEs is exactly that, what you described. It's, hey, how much risk, because again, they have their own data. So how much risk do we see in this property, or how much uncertainty? If low, appraisal waive. If high, require appraisal. So just as you described.
So last prediction, and we're gonna close out this episode, Alex. So the last prediction, which was number 10 on your list, number 5 in our review today, the luxury real estate downturn will spread from the ultra high net worth to the merely rich. I love the categorization of the merely rich there. So what's happening in luxury, and how are we seeing that play out by the end of the year?
Yeah, that's an interesting one. From my perspective, that was largely rooted. Well, that was an example that was evident during the last crisis, the great financial crisis, where there was a pretty significant pullback on the luxury market. As far as the, kind of the pullback from, what was it? I forget the other word for the insanely wealthy versus the merely rich. we'll see. I guess I'm still maybe on the fence on that prediction playing out, getting the point on that one. I think depending on where that line is, I guess, like there is an insulation, I think, for, however merely rich you are, that you can weather a short-term economic cycle and not, feel so inhibited of, making financial outlays, whether it's home purchase, investments, or whatever. Whereas if maybe you're the ultra wealthy, maybe you're not buying islands or these, massive portfolios or other things. But even that's a stratosphere, though, that I think is like all rules go out the door. And it's
yeah. I mean, we might have fewer crypto billionaires dropping money on Lambos and beachfront houses in Miami, but there still are business owners who are doing those things.
Right. That's right. Exactly. That's a good way to put it.
All right, Alex, thank you so much for this fun conversation, exploring the intersection of data and real estate and investing in the future of technology in the housing space. These are the topics that could go on for days about. So thank you for sharing your expertise. Thrilled to learn more about Resi Shares and excited to revisit some of these predictions.
Yeah, you bet, man.